All right, good morning. Call to order the December 17th, 2025 North Carolina Investment Authority Board of Directors meeting. Welcome, everybody. I'm a little disappointed I only see one Santa hat in the crowd, so we got to do better next time, folks. Please join me in the Pledge of Allegiance and the salute to the North Carolina flag. I pledge allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the Old North state love, loyalty, and faith. All right, thank you, everybody. Administrative matters. If anyone wishes to make a public comment, please sign up at the list and the table in the back over there. Please note that this meeting is being recorded and will be posted online with the other board materials. We will be taking roll call by name for all votes. Unless there is an objection, a motion, and a second will be counted as yes votes. Finally, texts or other recorded communications between board members during the meeting, even on personal phones or public records to the extent that they concern the meeting. We will now do a roll call for attendance.
Ms. Lynch?
Present.
Ms. Shipping-Russell?
Here. Present.
Mr. Roberts? Present. Mr. Ward?
Present.
Treasurer?
Here.
Quorum.
All right. Well, thank you. In accordance with the State Ethics Act and the board's code of ethics, it is the duty of every board member to avoid both actual and potential conflicts of interest. Does any board member here have any known conflict of interest with respect to any matter coming before the board today? If so, please identify the conflict and refrain from participation. Hearing none, we have obviously a very important topic today, and our friends at Ortec are here to help us with that. We'll get to that in a moment. Let's begin with the approval of minutes. You will have seen a slight addition or amendment to the minutes that were originally distributed that you all should have. So if there's any discussion, happy to entertain it now, or a motion to approve those minutes from November 19th, 2025. Mr. Ward, is there a second? Second. Mr. Roberts, please call the roll.
All right. Ms. Lynch?
Approved.
Ms. Shipping-Russell?
Yes.
Treasurer?
Yes. Okay, thank you. So now to get to the meat of the matter, we're going to go over to the asset liability study. Did you want to use it?
Yeah, so I'll start. I'm going to do kind of an intro, highlight some of the key asks that we're making at the board today and what we're not asking for as well. I'll talk a little bit about some of the key inputs that came from management into the modeling work by Ortec. And then they'll do their presentation and I'll come back and kind of round it out with part two. So the board meeting topics for today, we're really hoping to walk you all through the trade-offs that there are kind of facing the decisions around the investment policy, setting the strategic asset allocation. Both the kind of the opportunity of improving results over time, but also managing the risk profile plan. And we do this in an asset liability framework so that we can look beyond just volatility of returns and drawdown risk. We can look at the impact on funded ratio, contribution rates, and the potential to give or grant COLAs by the boards, teasers, and elders boards, and General Assembly to the extent they have a role in that as well. One of the things we will be hoping to get back from you today is some general confirmation that we're in line with the risk appetite that you all want to adopt for the retirement systems. And the way that's expressed in statute is around an absolute risk operating range expressed in debt and equity. And as we talked about in the pre-board calls, that'll be mostly focused on what we're calling the strategic guidelines, the kind of a high-level strategic asset allocation and some benchmarking. So it's not a big ask today. We're not asking for approval per se of anything, but we want to get some good feedback and discussion around how we've positioned the portfolio, the model portfolios. And then in February, when we come back, for that board meeting, we would want to bring the full investment policy statement, all the guidelines, risk budget settings, and things like that. And then that would be a decisioning meeting for the board that would have some import. So in the first part, just a reminder that in an asset liability study, we're able to look at a common factor that shows up on both sides of the balance sheet for the retirement systems, notably inflation. So inflation, as you know, hits the asset classes, particularly fixed income, but we also have sometimes beneficial impact through real assets like infrastructure, real estate, and things like that. But inflation also flows over and hits the liabilities, the promised obligations that come from the plan sponsor. And it does it in two ways. One is over longer periods of time, inflation tends to impact the growth of wages. And because a defined benefit plan is, the outcomes are strongly related to the formula, which is based on average high compensation, then that flows through and increases the liabilities over time. And then the other aspect is, again, the COLAs. So to the extent that there are COLAs granted to the retirees, it tends to be a function of inflation, sometimes lagged over periods of time. So we want to be able to show that in the modeling. And then 2 words about the modeling. You'll see lots of information that came first from Gallagher with strong support from Patrick. And Patrick, you want to hold your hand up and let people see who you are? Yeah, Patrick is the department's actuary. And so we really couldn't get to this point without really, really good, strong, responsive support from Patrick and from Gallagher. But we also want to have an important caveat. We're not trying to supplant the work of the actuary, right? So the level of modeling that takes place with Ortec's support is really to just help set the investment policy, but it doesn't serve as any substitute for the primary work that Gallagher does to support the boards that set some of the benefit policies and funding and things like that. So there's limits in terms of how deep we can go on the liabilities, and we're not trying to step in the shoes of the plan actuary. So the projections that Ortec will walk you through, we have several candidate portfolios. We show the current strategic asset allocation, various outcomes. We actually have the December 2024 portfolio as well, so you can kind of see progress versus where we were then with a lot of excess cash. We'll show a peer group, which I'm going to highlight how we came to that peer group in a minute. Large endowment and foundation universe, and then 2 model portfolios. So the first model portfolio, MP1, has a very similar volatility profile as the public pension fund peers that we've selected. And then MP2 is a lower volatility portfolio, and it pretty much gets to slightly above 6.5% expected return. And then those will be compared against two basic sets of portfolios. A reference portfolio, and all that does is it shows a very simple, naive implementation of public equities, totally passive, and then U.S. Treasuries with more than 5 years of maturity. So we feel that that's a good risk-free measure for a pension fund. And then the optimized portfolios will take all the expected returns, risk, the correlations, and constraints, which we devised here at the management level, and I'll review those in just a sec, and gave those to Ortec to run. So this is a slide as a paraphrasing of what the statutory requirement is around the absolute risk operating range. And the 2 key aspects are we're trying to maximize long-term returns with reasonable risk. And then the risk can't be undue relative to similarly situated U.S. public pension funds. So that's where we come to how do we set the public pension fund peer group. And what we did here, we're showing some metrics on the far left and teasers. So we're just showing one plan for the purposes of setting the peer group. So we looked at similar size, so a range of 50 billion to up to 230 billion. The ratio of active members to total beneficiaries is a rough measure of like how mature a retirement system is in terms of cash flow that are needed. Net benefit paid to total assets is a similar type of measure. We pay out on a net basis from teasers about 1.5% of the assets each year. So that's total benefits, netting out contributions. So we fall kind of in the close to the average of the peer group. And then the funded ratio is the key metric for trying to set up this type of peer group. So teasers is about 90% funded, and the range of the peers are roughly 80 to 100% funded. So these are the.
Kevin, quick question. You showed this, it was probably at an IAC meeting last year, or earlier this year, I guess.
Mhm.
The net benefit paid is, we've been really low for a long time. I know this is one plan, right? Am I remembering that right? And it wasn't going to increase, the expectation was we wouldn't increase that much over time, or?
Well, put it this way, the hope is it will increase. And the reason it's a hope or an aspiration is that to the extent that we compound at higher rates of return, then the contributions that need to come in from the plan, from the employers, will decrease over time, right? And then as the kind of the benefits will grow over time as well. So on a net basis, that number should actually start to
Should
go.
actually go closer to average.
Yeah, exactly. It's also an important metric for us as we think about the risk profile, how much liquidity we maintain, and what's the right mix there. Because in certain circumstances, kind of financial crises, that number can go quite high relative to kind of how the markets are moving, the denominator effect. So we know what the impact is on the allocation to illiquids, but then this number also tends to be a function of what's happening to the base assets as well. And then one final point that we actually had Ortec do the modeling of both plans, teasers and LGERS. And so in the board materials, all the LGERS information is in essentially an appendix. And the reason is that the modeled outcomes as it relates to the investment policy, the strategic asset allocation, are almost dead on. They're really not distinguishable. And so we're not going through, for the purposes of today's presentation, one presentation on teasers and another on LGERS, because it's going to be very, very repetitive. So we're just going to focus on teasers today. So for these are the public plans, all recognizable names. They all run pretty good programs all in terms of both investments as well as their funding discipline. Hence, the funded ratios are around 80% and better. For the endowment fund, we used aggregate information that comes from the DeCoupo survey, and we picked the larger asset-based endowments. So there's 29 participants with more than $5 billion in AUM, and we had to do a little bit of mapping on their actual asset allocation to get them into our categories, but we think we're in the ballpark. So 2 tables of key assumptions and constraints. I'm not going to go through these. I just want to highlight how we approach some of it. The expected returns, the volatility, those come from Ortec. We had a few discussions and adjustments, but nothing major. We tend to want to avoid trying to be too precise on these figures because they're just, to all due respect to Ortec and everyone else in the industry, they're just not that robust in terms of predictability and accuracy. The markets deliver what they deliver, right? But we think that where the effort should go is more around making sure we have liabilities reasonably modeled, the common factor of inflation, and then look at judgmentally reasonable strategic asset allocations, and then get some assurance through the modeling that it's a fairly efficient portfolio compared to what we've had historically or other alternatives. Yes, ma'am.
I just wanted a little clarification. Why we're using the arithmetic mean here versus a compounding, because arithmetic does not include compounding, as I understand it.
Yeah, so it's this is one of the wonkier aspects of
That's what I
doing that.
thought I'd ask. I don't know Wonk very well.
Yeah, so it's kind of the convention in the way that asset liability studies are done. And I guess I'll invite others to chime in as well, but this is the way I think about it. For each one of these line level asset classes, in essence, year by year, they print a return, right? So if I look at the historical figures or I look at what the building blocks are that go into determining a reasonable expectation for private equity as example, right? It's going to have some relationship to public equity and then the kind of different characteristics might be a illiquidity premium or it might be that it's slanted more towards value and smaller and mid-cap companies, they have their own characteristics. So that changes the outcome for returns. So if I look back over, say, 30 years, or I look at that forward-looking model, every year there's a print. If I take the average of those annual numbers, that's the arithmetic return, right? So it's essentially like, when we learn about probability, there's an urn, and in that urn are colored balls, right? And you reach in and pull one out and write it down. It was red. Pulled another one out, it was white, right? And then over time, you figure out sampling over and over what the expected outcome is. Okay, so that's essentially what we're doing.
So because you're doing it annually,
Yes.
it sort of captures that.
Yeah. Exactly. And then the volatility is, as you pull those out one by one or year by year, what's the spread around that average? Okay, so the task of designing the strategic asset allocation is to say, okay, so we have a long list of things we could choose from. We know on average every year what number is going to get produced. And then there's connections between these asset classes and kind of statistically refer to it as correlation or covariance. So there's certain common things that happen. Public equity does well over long periods, so does private equity. They're very, very tightly related. So we bring them in as a standalone and try to figure out what's the right mix. And then we figure out the risk of the portfolio. So net, when we figure out the risk of the portfolio by varying the asset allocation, then we know what the compounded return is going to be over time. Okay, so.
I got it. Yeah. Have this great statistical pressure there.
It's the challenge is if we look at, again, I'll use private equity, the return premium that we're modeling for private equity over public equity is probably about the right reflection for what we think when we look year by year. Over time, if private equity is on a standalone basis and we just look at the compounded annual rates of return, it'll actually be lower than that 9.1%. So to get the right mix in the portfolio to reflect the portfolio effect, we use the arithmetic return. If anybody's got a better explanation, and I'm sure there's many.
I thought that was an excellent, and I understood it fully, so I appreciate it being put in relatively layman's terms.
So the illiquidity scoring is relevant because we have the statutory cap of 40%. Chris, you want to talk about how the score?
Sure. Yeah, so for this analysis, we tried to take a conservative approach here, and we didn't add really the asset class and the sub-asset class level. There's probably more embedded liquidity in a lot of these, and it depends on how we define liquidity or illiquidity, which we're going to do more work on and come back to you probably in the February meeting as well. But so if you take core real estate, for example, we have 80% illiquid. So by policy, we have 20% in public REITs in that core real estate bucket. So those we've categorized as liquid. The other 80% we categorize as illiquid. Now, again, it all depends on how you define that. We have a lot of different types of structures within that private real estate bucket, some open-ended, which have some more liquidity likely within it. But we tried to take a conservative approach for this first pass here, and then we'll refine it when we determine how we're going to measure this on an ongoing basis and make sure we comply with that 40% illiquidity cap that we have in statute.
The only question I have on this slide, maybe it's
for Ortex. I was looking for it in the back. The implied correlation between venture and private equity has got to be really, really low, just to make the math work for the aggregate private equity volatility. I didn't see that in the correlation matrix in the back. Do you guys know offhand what that correlation is?
Let me see if I can find it. That correlation indeed also depends on the horizon over which you observe it. I think we included 2 tables. I don't know by heart, sorry.
Just more curiosity.
Yeah.
Is the surprising result of lower vol for the aggregate than any of the components?
Yeah, that's a good point.
So the constraints, we provided the constraints for the optimization to Ortec. And basically, we looked at our peer group, asset class by asset class, to see the broad range. And then we want to give the optimizer the ability to go and find the best portfolio. It's a simple mathematical exercise. But the constraints, try to get us closer to the feasible set. The optimized portfolios still have a lot of characteristics that we don't think should be reflected in our judgmental portfolio. So there'll be quite a few portfolios that have 20% allocated to global public equity, 40% to investment grade fixed income. So on paper, coming out of the optimizer, it looks attractive because it has a nice mix of return and risk. But then when we think about it over the real world economic and financial cycles, we don't think that's something we would ever recommend. Okay. So with that, I'm going to turn it over to Ortec. So Matt, if you want to flip the.
I think we have a ticker that works.
Just look over here in a second.
Maybe try to pull that yellow thing off the tip of it. Try to block the laser from flying forward. I'll move it. Just tell me when.
Next one, please.
You need to go to their presentation.
Yeah, go for it. Yeah, there we go. Great. Thank you, Kevin. And just an introduction. I know you met Stacey and Tom in summer when they visited, but my name's Ben Hudson. I work in the UK office for Ortec in the pensions risk team. And thank you for having us over here before Christmas as well. So in terms of what we're going to go through, I'll very quickly summarize the ALM process from start to finish and where we are now. High level key findings, but the majority of the session we're going to focus on, as Kevin mentioned, the modelling and the projections of where we are now. But the beef of the session is going to be on the SAA and the optimisation. So I will move quite quickly through the first 2 points, just so we can spend a decent amount of the time focusing on the SAA. So the ALM process from start to finish looks like this. So Tom and Stacey visited in June or September to go through the assumptions. But where we are now, so we've evaluated the current status of both plans, which we'll go through very quickly. And we've also carried out the analysis for the SAA and the alternative allocations that Kevin mentioned. So yeah, that's the bulk of today's session. And we've got a follow-on session in the new year where we'll do some analysis on some stress testing as well. So the study's not finished yet, but the bulk of the work is going nicely.
That's good. Just a quick generic question, because thinking about the difference in funding between TSERS and LTERS, their funding ratios put 5 points apart essentially.
Yeah.
And I think rightly we're considering them the same for this purpose. How big can that number get before we should really start thinking about them separately?
I think it's not just the numbers as they are now. I think you've got to look at kind of from start to finish. So you'll see the projections. The projections are the same as well. So I know the points are important, but it's kind of the profile, the shape, the pattern, and it's kind of very consistent story throughout. I think if that starts changing, so if we saw the funding projections for both over the next 20 years and something starts to deviate, then we might want to start questioning what's going on and do we need to look at things differently. But overall, it was consistent throughout the board on for every metric.
So as long as the lines are parallel.
Pretty much.
All right.
I think what helps in this case is that LGIS, although it starts at a bit of lower funding rate, should actually trend upwards a bit faster than TSERS, so it brings the two together. And that's very helpful. If they start to deviate for whatever reason, then I think that is really a call to look at these in more separate cases. Yeah.
Thank you.
So at a high level, I think as kind of mentioned and Kevin highlighted that both schemes are looking very healthy and their projections look very healthy. They're both tending towards 100% funded over the next 20 years, which is great. There is some downside risks there, but it's quite small. On the asset side, you'll see that it's mainly around equity risk, which is kind of a given allocations. And on the liability side, there's an inflation risk there too, but I'll come to that in a second. We have made an allowance for COLA. We'll go through the assumptions that we've done. We've worked with Kevin and the team to kind of set up a rule and formula for that. And again, the optimization we'll get to later on. And quickly, please interrupt me because again, I'm going to go quite fast through this part. But on the assumptions, we have been consistent with Gallagher. So we use their valuation results as well as their latest experience study with help from the team. So the key point here is that we are consistent from point zero. Over the long term, obviously, we don't know exactly how Gallagher model their projections. We'll never know what's under the bonnet, so there will be some inconsistencies. But high level, like Kevin said, we're comfortable with how things are looking over the projections. Okay. So I'm going to summarize just some of the kind of key outputs at T0, and this is just for teachers. You've got the algebra sections laid down in the deck. And again, we'll be skipping the commentary because I'll be going through all the charts. So the first one here, we have the assets and liabilities. And for those who haven't seen these before, these are funnel charts or fan charts. And they capture all of our scenarios and present them in a distribution of where they fall. So for example, if we look at the assets, so we model 2,000 scenarios or simulations, and those 2,000 are laid out there and distributed as where they fall. So for example, the thick dark orange in the middle, that's the 50th percentile, so that's where the 1,000 scenarios fall. And why do we do this? Because it tells quite a nice story. So straight away, if you look between the assets and liabilities, the fan of the assets is much wider, and quite clearly that's because it holds more risk and more volatility, which is what we expect. There's more asset classes at play, and hence more risk, whereas for the liabilities, it's only really wage inflation, which is the key risk driver. Some other stories to note here that you will see that the assets at T0 do start below the liabilities, but as we mentioned, as we look over 20 years, the assets actually go above the liabilities as we get to that surplus level. Next. And the story kind of follows from funding ratio. So as you can see, we are tending to about 100% over 20 years. This is, as I said, consistent with Belgium as well. The risk drivers, if we look at the higher scenario, so the thinner orange going upwards, this is an example on the asset side where we're seeing strong asset returns and potentially on the liability side some low inflation. So then liabilities are performing poorly, assets performing well, and you get the strong performers. And equally, the story is vice versa on the downside. On employer contribution, so there's an obvious kind of story you can see here after 2 years. After 2027, the fixed contributions that were a part of the schedule, they come to a stop. And hence you see the contribution rate declining down to 6%. And the 6% over 20 years, that matches the employee contribution rate, which the rule states that the employer contribution can't go lower than that. The ultimate net cost, we define this as the cumulative contribution up to that year, so say in 20 years, up to year 20, plus the unfunded liability at year 20. So the way to see that is what is expected to be paid over the next 20 years, plus what is owed at the end of that 20-year period. And the rule to follow here is that if that number is negative, then the fund is looking to be in a surplus. So again, the bottom kind of strong performers, that is in a situation where we're seeing a strong funding ratio, strong asset performance, and reduced liabilities. But again, I think the key point, and I'm going through this quite quickly to get through to the beef, is that there's no surprises. The scheme on both sides is doing what we'd expect and is in line with the actuaries' projections as well, which gives us some good confidence that the model is set up how it should be. And that's what's important as we go into the optimization part.
And I'll take it from here. Next, we have also modeled cost of living adjustments, which can be granted by the board discretionary. Obviously, it's always a challenge to model this, and in a model we need to try to capture this in a rule-based manner, which is always going to be a simplification of the real process. But we use a two-step approach here. First, we try to we create a budget, and that budget is defined by the excess return of 6.5% at the discount rate over a 5-year period. And next, we've specified certain thresholds in terms of funding ratio, of which a percentage of that budget can be applied for COLA. So imagine you have 100 billion in assets and the excess return is 1%. That creates a budget of 1 billion. And with a funding ratio of 100%, that means that 50% of that 1 billion or 500 million can be applied for COLA. How much is actually used is dependent also on the level of CPI. So we go to the next slide. Here you can see on the left-hand side the indexation ambition. So this is basically CPI. Starting at an elevated level currently, and then slowly normalizing to its long-term average expected of 2.25, with a certain level of uncertainty around it. You can see that 50% of the scenarios range between about 1% and 4%. At the same time, this ambition is capped at 5% and floored at 0. And that floor basically means that if there's any deflation, we're not going to reduce the benefits. Then on the right-hand side, you see the actual indexation that's being granted in a model. So depending on that budget, depending on that funding ratio threshold, and depending on the level of CPI. So here you can see that in good scenarios, we grant up to 5%, and in other scenarios, I shouldn't say good, by the way, because that's dependent on, it means inflation is high, but in certain scenarios, indexation grant is up to 5%, and in others, it's at 0. For the median in any given year, it is actually at 0. However, at the same time, over time, as we progress through the simulation, indexation is being granted. We find that after 20 years, around 28% of the ambition is being granted as cost of living adjustments. Now, another way of looking at this is through the lens of purchasing power. So on this slide, we look at the development of the purchasing power of the benefits that are being paid to a retiree, starting at 100% in 2024, and then gradually over time, it can reduce as inflations occur, and only part of that is made up by cost of living adjustments. So here we find that it trends in the long term to 80%. Initially, the decline is a bit quicker, and that's due to the funding ratio is now at lower levels than it will be at later years. And you can see the uncertainty around this distribution as well over time.
So this will come up in when we look at the optimized portfolios and the model portfolios as well. But to try to simplify this a bit, there is this tension that occurs in a defined benefit plan. If you take COLAs off the table, it is intended to be essentially a self-equilibrating system, right? If the returns are good, the contributions that are necessary can go down over time. If the returns are not so good, then the contributions have to go up, right? That's why there's this tendency over longer periods, as long as North Carolina has demonstrated repeatedly, there's a discipline to put in the right amount of money, right? The contributions, that you'll end up towards full funded status eventually. There has to be a right amount of investment risk as well. With the COLA, or the potential to grant a COLA, there's going to be tension between granting the COLA and the impact on the contribution rates. So to a certain extent, what's happening here is just with the model that's been assumed for how the board makes a decision, right? It's all hypothetical. That's all we can do for this model. We can see there just is not that much opportunity to protect the purchasing power of the retirees. There's some ability to offset the impact of inflation, at least in the model. But you can see it still is, for all intents and purposes, a fixed defined benefit payment. Again, I don't want that to be kind of lost, because later we're going to have a somewhat depressing message about how much we can do with the investments to improve the likelihood and the size of the corridors. This is reflecting our current asset allocation, strategic asset allocation.
Not major, but another kind of wonky question. Did you model inflation as trending or discontinuous?
Discontinuous, so it can go, up and down. And maybe good for context. So here we see that the median is trending towards 80% after 20 years. If we would have no quota at all, it would be at 70% in the median. That's about a 10% gain. On the next slide, we zoomed in on risks. And therefore, we use our risk factor decomposition tool that allows us to assess risk on the total balance sheet, the assets and the liabilities. So we zoomed in here on the 5% worst case surplus scenario. So basically, when there is a deficit. And this is shown on the left on the 1-year horizon, on the right on the 10-year horizon. And what we find is that in both cases, risk is dominated by equity risk, which doesn't come as a surprise given the exposure to equity in the portfolio. What is very interesting to see is that if we zoom in on the 10-year, we find that inflation is also a major risk, especially on the liability side of the balance sheet. In isolation, we find that this risk can create a loss of $20 billion, $21 billion, over the 10-year period compared to the expected outcome. Now, this risk typically does not occur in isolation. So if you consider also the other risks, then in those worst case scenarios, the marginal risk is smaller than that and is around $5 billion. So that's for the first part of the presentation.
A little bit more clarification, I'm sorry, on this graph table you just had. The gray section of those bars is diversification. So that's basically the term that's due to diversification in the asset class.
Yeah.
The bars are the risk associated with it.
You can say that, yeah. So how this analysis works is that when we look at the total risks, those are the orange bar, those are the 5% worst case scenarios that we zoom into. And if we dissect what is driving those scenarios, then we find these blue bars. So that's what we call the marginal risk. However, what we can also do is look at the 5% scenarios wherein the 5% worst inflation scenarios. And then we get the sum of the blue bars plus the gray bars. So that's roughly 20 billion.
Orange here is the sum of the blue bars, is that right?
I'm sorry?
Orange here is the sum of the blue bars.
That's correct. Yeah, so if we were to zoom in only on inflation risk, that creates about a 20 billion loss in the worst case scenarios. But if we look at the overall worst case scenarios, then inflation only plays a limited role in that. It's more driven by equity.
Okay, thank you.
Are there any other questions about the first section of the presentation? Then we continue with the strategic asset allocation analysis. So a quick recap on the process that we used. So the aim here of the analysis was to identify portfolios or strategic asset allocation that ensures long-term continuity of teachers and Algis, while minimizing risks and of course also considering practical limitations and the liquidity scoring. Ultimately, the analysis that we did, including the optimization runs and the peer portfolio analysis, has led for NZRS to present 2 model portfolios, the results of which we'll show in a minute. And we've also checked the robustness of these outcomes by simulating them stochastically and seeing how these portfolios perform again in the various ALM metrics, as well as the risk decomposition tool that we just saw. And later on, we'll also run stress scenarios to further investigate how these model portfolios perform under various adverse scenarios. And finally, we also define reference portfolios, which consist of 2 liquid asset classes, equity, all country worlds, and US Treasuries. And the idea is that these reference portfolios can function as a benchmark to the model portfolios. So the way that we identify this is we pick them based on the same or similar investment volatility. But obviously, the model portfolios having more asset classes will be more efficient and are expected to perform better. Then on this slide, we zoom in on the optimization process. So we've optimized funding ratio, return versus risk. So really taking into account both sides of the balance sheet. Risk here is defined as the 5% worst case scenarios, and we're generating 10 optimal portfolios. As Kevin and Chris mentioned, the allocations are constricted to force the model into realistic portfolios and also considering the liquidity constraint of 40%. So each asset class has a liquidity score. We can multiply that with the weight or the allocation to that asset class. And if we take the sum of all those weighted averages, then we get a liquidity score for the full portfolio. And the optimizer is not allowed to have that number go beyond 40%. Our focus now is on the 10-year horizon, but we've also assessed the optimizer outcomes on a 20-year period as a robustness check. And with that, I think we can go to some of the outcomes.
Question on that last page, I don't know if it's for you, Kevin, or you guys. How did you, so like venture stood out, like we used a 4% assumption, I think, in venture. Like, how did you think about the ability of the plan to actually execute on these and hit these assumptions, given the size that we are? I know it's more of an art, not a science, but curious kind of what was your thinking of that?
Yeah, and that's a very important consideration at this stage for the purposes of doing the modeling. We kind of abstracted from the reality, just to be blunt, right? Now we have certain, if you look in this table under private equity, the constraints that allow us to go up to 35% of private equity in venture. So that reflects a little bit of that judgment that our private equity program is not going to be primarily venture growth, right? It's going to be venture and growth are going to be a smaller component. But really most of the judgment about what's implementable comes later when we put together the model portfolios.
I think I get it, but I just want to say this out loud and make sure I get it. So, and we'll stick on we'll use the real estate one as an example. You've got a min of 0 and a max of 20. So the categories below are conditional underneath the real estate category. But if we do any real estate, does that mean that 20 and 30% of what we do have to be, as they're listed as mins underneath that? Or value add and opportunistic? I'm just trying to understand the mins underneath the category.
Yeah, correct.
If we do $1 of real estate, 50% is allocated on those two categories when we start.
Yeah, so the numbers below the 20% row, so the subcategories define the relative allocation.
I thought I got it, but I just want to make sure.
Very good. Okay. So now we're going to look at the results and I'll slow down here a little bit. I think this is important. So what we're showing here are the outcomes for just the current strategic asset allocation. With on the left, the investment return over a 10-year period of time. And we're showing here the geometric average return on the y-axis. And you can see that the SCA generates a return of 6.5%, decent for expectation. And that's with the volatility on the x-axis of a little over 10%, 10.5%. And we can also see how this portfolio performs in terms of funding ratio. So it's in line with the Venn chart that we saw earlier on. And here we see that in the median, it performs, it creates an expected funding ratio of just above 96%. And in worst case scenarios, we find that the funding ratio drops to levels around 70%. So that's the staging ground. And then as we continue to the next slide, we add those reference portfolios. So these consist of only public equity plus US Treasuries, ranging from 0% equity on the bottom to all the way up to 100% equity portfolios. And we can see how these perform relative to the strategic asset allocation. And given that they have less asset classes, they're less diversified, each of them performs worse than the current strategic asset allocation, as one might expect. What's interesting to note here is that on the left, we see that the strategic asset allocation in terms of risk is comparable to a reference portfolio with 60% equity, creates the same investment volatility. However, if you look on the right-hand side to the funding ratio, you see that the SCA has a similar risk level as 45% equity. And the reason for that is that obviously the SCA is more diversified, but it also has a stronger link with inflation, which helps to hedge some of the inflation risk on the liability side. So it's a portfolio better suited for a pension fund, basically. Next, we can add the efficient frontier. So these are the 10 optimal portfolios that we generated, one being the most risk averse, lowest return, all the way up to 10 with the highest risk and return. And here we find that there is room for improvement compared to the strategic asset allocation. Portfolio number 5 shows the same return as the strategic asset allocation, but at lower levels of risk. On the other hand, if we look at portfolio number 8, we see that we can also generate a high return for the same level of risk as the SAA. And we find that if we look on the right-hand side of the slide, you can draw a similar conclusion in terms of funding ratio. So with the constraints used and given all the assumptions that feed into the optimizer, it being a model, there seems to be some room for improvement. Then on the next slide, here it becomes a bit more interesting as we add both the peer portfolios, the actual portfolio, and the model portfolios all in dark blue. So if we start again on the left-hand side, we see that the actual portfolio per the end of 2024 is lower risk, lower return, and doesn't seem to be very efficient compared to the current SAA. We look at the peer portfolios, then we see that for endowments and foundations, this is really an outlier. It's similar to portfolio number 10, so really high risk, high return. Not necessarily in line with what is necessary for a pension fund like NCRS. We look at the more direct peers, the direct peer group, the pension funds. I think a similar level of attractiveness as the current SAA, but at higher risk and return levels. Based on this information, NCRS has created 2 model portfolios. One is, so MP1 has roughly the same level of risk as the peer group, but generates a high return, so it's more efficient. And MP2, for roughly the same level of return, shows a lower level of risk and is more efficient than the current SAA. So from that point of view, if we look at investment returns, these are both more interesting than the current SAA. Now, if we look on the right-hand side of the charts, we can draw basically the same conclusions. Again, MP1 is more return focused, MP2 is more focused on risk reduction, and both are more efficient than the current strategic asset allocation.
Can I ask one question?
Go ahead.
Thank you. Just explain the difference between MP1 and portfolio number 8 on the investment return chart. Is just 8 not as investable? Is that why you discarded it?
Yeah, so for portfolio number 8, that one is created within the realm of possibilities that is allowed based on the constraints that we've set, which are relatively wide. And for the model portfolios, NCRS has incorporated more qualitative considerations as well to make this a more practical, implementable portfolio. But maybe Chris or Kevin, you want to?
Yeah, what I was going to comment on, Stephanie, is that I think one of the key asks from the board, not this instant, but as we get through the presentations, is MP1 kind of in the neighborhood of where you all would like to be risk-wise? It's easiest to see here on the left-hand chart, the volatility. And, you know, we could do further work before February to try to find ways to enhance MP1. And one of the key things that we need to do with Ortex assistance is look at some stress scenarios, right? And, you know, again, towards the end of the meeting, I think it'd be helpful to hear, are there particular stress scenarios you want us to look at, like high inflation, low inflation, stagflation, things like that? We could pull those out, and it's very straightforward given their modeling approach. And if MP1 is not what is in the kind of the board's consensus risk appetite, then we would like to get steered somewhere else. And then we can come back again with further analysis and detail around a different type of portfolio. So that again, just as a placeholder, that's a key ask. We need to have a sense of, are we on the right track for your all's risk appetite? And so go ahead.
Thanks. Yeah. So now we've zoomed in on investment return and funding ratio. As you know, the gains or the improvements Not all end up in the funding ratio. They can also show up in lower contribution rates or higher cost of living adjustments. So to that end, as you go to the next slides, we look at employer contributions. So here we'll straight go to the full overview. Yeah, again, you can see that there is room for improvement, with the optimal portfolios in green being more in the bottom left corner, with lower expected median employer contributions, and also with the 5% highest contributions being lower in the expectation. What's interesting to note here is that if we look at the peer portfolios, they seem really less suitable for NCRS in terms of what it does to contribution. And they're less efficient than the SAA. And we find that MP1 and MP2, again, which also has a considerably higher return than cash and credits, obviously. So that's why it's being allocated. But in addition, it also has a strong link to inflation, which makes it relatively attractive. All of this comes at the cost of public equity, which shows a rather sharp reduction in pretty much all the portfolios. That's just because the other asset classes are more attractive than public equity, with the CMAs that are being used there. And to a large extent, that's being driven by the relatively high or higher than recently seen interest rate levels. So then, a lot of numbers. I'm not going to recite all of them, but here we show the allocations to the current strategic asset allocation, the model portfolios 1 and 2, the peers, the actual portfolio, and then also optimal portfolio 4 to 9, which are the most interesting ones. And I'll pause to see if there's any questions on this table.
Kevin, how often do we do this asset liability study? Can you remind me?
Yeah, so again, that's partly a function of how the board would like to operate. And in the old days, we would just say every 3 to 5 years, right? Frankly, it was almost a set it and forget it kind of exercise. Having come through several crises, I found it actually makes more sense to either do every other year or even annual refreshes, just to kind of reconfirm. And in this case, based on statute as well, every 2 years, the board should set that risk operating range. So I would think we would at least revisit this every 2 years, maybe not go through the full, study, but kind of refresh the capital market assumptions, what we think the starting point is for the markets and the forward curve on fixed income in particular. So that's what I would suggest.
I appreciate that. Part of why I ask is, like, MP1, 2 are fine, but the biggest risk we have is rates go down. A big risk we have is rates go down. So we need to just make sure we refresh it, because it's very logical given where things are today, but we all know that could change in a year or two. So.
Yeah. I'll add on to that comment. So there's so many kind of paths we could take in terms of the analysis. There's a lot of additional analysis. We're not trying to get it all on the table today, but I'll give you an example which ties into your point. If we look, this is our 10-year numbers. If we look at the 20-year horizon, we get some different outcomes, which we reflected in our MP1, for instance. So over the next 10 years, there's a widening of credit spreads that are in the model, investment grade as well as high yield. So then the model over the 10-year horizon doesn't like our non-investment grade credit allocation that much. But when you look at it over 20, because the spreads have widened in the second half of that, they're much more attractive. So I think it's to the tune of about 5 percentage points of the plan. So we think about that a little bit differently, in the sense that in the near term, we could live with MP1, but as we implement we would continue to probably keep a cap or rotate away from generic non-investment grade corporate credit, high yield, leveraged loans, lean into things like asset-backed or asset-based, so commercial real estate mortgages, as an example. We think that that opportunity set is much richer and will avoid some of the spread widening that we might, witness going forward on the corporate side, the performing corporate. So we can manage it, and I'll talk about this a bit more when we get to the second part of my presentation, but that's another component of how we need to think about it as investors, not as like engineers and mechanics, turning dials and getting to this perfect theoretical portfolio.
Maybe to that end, you look at OP6 and OP7, which are kind of directionally the optimal portfolios, most similar to MP1, and you look at the difference between those outputs and MP1. It might be useful, just from a practicality perspective, to walk through the high-level asset classes and say, we're at 32 in MP1 in public equity versus 20 in OP6 and OP7. Why? I think it's largely an implementation question, and we just can't get there from here. But I think that might be helpful for folks as you wrestle with the difference between MP1 and the optimized performance.
Yeah. I mean, the other aspect, again, is we're happy to do additional analysis. So MP1 is, we think, kind of in the right spot, but we can tweak that. And then at the risk of being repetitive, this sounds and looks super precise, right? Very detailed. And it's useful to make sure that we're taking into account all the factors. But ultimately, the world changes every second as we move forward. We have an existing portfolio. So what we'll ask for in a bit is broader strategic guidelines that allow us to kind of reflect the opportunity set as well as the risk environment, and move the portfolio over time towards MP1 or something close to it. So to me, that's where the investment, kind of art comes in, which is we have to be reflective of our existing portfolio as well as what the current market offers and future markets. So, what do you want to do for next steps in terms of, I think they're pretty close to the end of their presentation. I have one other comment I wanted to throw out. Again, it was in the analysis, but we didn't put it in the slide deck. We routinely get questions about our fixed income portfolio, the investment grade portfolio. We have a longer than typical duration. And every time we do the asset liability study, we look at shortening up the duration and go into something like off the shelf, Bloomberg or Barclays Ag, and as opposed to a longer duration treasuries. And I think our corporates are closer to 9 years, something like that. The analysis always shows in this longer term context that the longer duration is better, and we will give up and leave returns on the table if we shorten up our duration. And then again, on a practical day-to-day basis, we have the ability to move our duration around relative to the benchmark. That's done with a lot of discipline. But again, we did that analysis and didn't suggest that we should be shortening up our duration as a policy matter.
I would just say, I think it's really important to make sure that we, a policy portfolio is always going to be different than the actual portfolio, but it's clearly a framework to follow. It's important to get it right in right pictures, but everyone, I think, understands that at any given point in time, it's going to vary. So that's my expectation.
Should I go on to my last piece? Go ahead. Okay, Matt, you want to pass it over? So this is just a replication of what Ortec had in their kind of final slide as it relates to the strategic asset allocation, the two model portfolios and then the peers. And so again, really what we would like to do is we need to do this level of granularity for the modeling. But we'd like to actually have the board be more comfortable with approving higher level, broader ranges. And so here I'm using MP1 as the example to base this on. So the idea would be we'd have essentially three components: equity, debt, and multi-strategy. Where multi-strategy is a blend of equity and debt over time. We have some overlap between multi-strategy and what could be in some of the other asset classes. But we see it as a way to have a portfolio that can go anywhere, do anything, be a place to have some macro oriented co-investments and thematic investments, and then be able to flex it up. So here the top end of the range is 10%, even though we would be expecting the target is 3. And then within equity would be essentially two high-level categories: corporate equity, which is public and private equity, and then real asset equity, which would be real estate and infrastructure, natural resources. So here we're setting out the traditional targets and then a reasonable range of kind of allocation, which we think fits with what was shown before around the optimizations and the risk postures and things like that. And then within debt, we would bring our investment grade, our non-investment grade credit, and then our portfolio cash. One level below this would be, and I'm using equity as the example, we would have the same targets and ranges at the bolded level. But then for public equity, we would have a reasonable range, but not necessarily a target. And so because this is towards the implementation, that while over time, if you're comfortable with being in that risk neighborhood of MP1, we would bring our public equity allocation down potentially to 32%, but it would take us a while to get there, and it would be a function of allocation to private equity. But we also want to have a process and a policy that ties to the process where we enforce a competition for capital. That there may be periods of time when, for various reasons, we don't want to commit and allocate into private equity. And we intentionally hold that overweight in public equity. But by the same token, maybe we also are able to hold some of it in, say, real estate or infra. And, again, at our size, we're going to always have to be invested in funds. We're going to have systematic deployment to funds, and then the funds are going to be making the actual investments over time. But we also want to have a good, strong discipline around this competition for capital, that we're not just going to back up as a negative connotation, a truck and fill the private equity bucket. And we're going to do the same for real estate. We don't want to operate that way. We don't think that's in the interests of the client, the beneficiaries of the plans. And so we want to be more market sensitive and have that competition for capital within the investment committee. On a quarterly basis, we'd be giving you all updates as to how we're implementing, why we're focusing on certain subsectors, certain types of strategies to the exclusion of others, or because we're minimizing others. And we think on a quarterly basis, that's a good kind of cadence to show how we're implementing to stay or get to that risk range, and then get input feedback from y'all as to how we're thinking about the markets and the opportunity set and the risks. So I'll stop there. That's kind of the main at the strategic guidelines. I have one more set of comments about benchmarks, but I wanted to pause here.
Yeah, I'm happy to give you back and look. I agree with that. I've always believed there should always be a competition for capital. But there's also a blurring of lines between the public and the private markets nowadays too. The whole idea of, hey, you just go to illiquids and you get 5% more is not the case. The world has changed in the last 15 years. So, and I think this helps recognize that. So our key risks are how much equity exposure and how much debt exposure, and then how illiquid are we? And those are the risks that matter the most in my opinion. I'll ask you some questions on the benchmark, but I'll wait on that to get there. So,
And it'll continue to change.
These are just suggestions. These are not set right.
Yeah, no, the formal approval, that ask will come in February. Okay, I'll hit the benchmark discussion and points quickly. So we think that the three primary benchmarks at the total plan level would be a policy benchmark, which is the reference portfolio. That's really most applicable over longer time periods, 5, 7, and longer years. The actual rate of return, so that would be that 6.5% annual return. And then a hybrid implementation benchmark. So that would be a hybrid in the sense that we have fixed weights at the equity and the fixed income level. So again, going back to here. So it's essentially the equity debt split would be fixed. And then we would have transitional, dynamic, floating. There's all kinds of terminology that people use to reflect the fact that, say, private equity, we would use its actual weight in the portfolio in this transitional period. And then once we got to the point where it was close enough to what we felt was the ultimate, the board felt was the ultimate portfolio, then we could fix that and we would have a standard fixed weight. But given the size of the differences we're contemplating, it seems to make sense to us that we have a floating weight as well. And then the risk budget would be key risk indicators, which again, will come back in February with some metrics around these particular indicators. And they would be reported on a quarterly basis to the board. So again, you have a good sense of our overall risk posture. Some of this we can measure by looking in the rearview mirror. Some of it will be modeled, including through ORTEC, like on the funded ratio and the risk to the funded ratio. And then some of it we can do on a forward-looking basis using some of the risk systems as well, although that'll probably develop more over time. So happy to answer questions around this topic.
what, actually, I want to benchmark, the 65-35, is that an ACWI you're thinking, or what do you think?
No, we're thinking it would be ACWI, and then it would be the 5-year and longer treasuries. So again, tying back to the reference portfolio, keep it very simple. We think for a pension plan with our horizon, a 5-year treasury is kind of like the risk-free asset as opposed to the ag or the cash or something like that.
Yeah, so the only to think about leading into February is we're more like a 70-30 risk. So like the policy benchmark, to be honest, of like, hey, we're taking 70% equity risk if you roll up the credit risk we're taking within fixed income. That's the only tweak there.
We'll come back with some analysis on that. Yeah.
I've got a broader question under the notion of the way we're looking at risk, because one thing, we're not looking at it here in terms of ways you can hedge specific risks. I mean, it's sort of woven into the return dynamic, but a lot of institutions sort of do focus on specifically, doing this to hedge against inflation, this deflation, this against various other options. Why are we not doing that?
So in some of the sensitivity analysis that we'll bring back in February to show how these portfolios perform in different environments, we should be able to show some of the hedging characteristics, right? It's not going to be in a traditional like corporate financial sense of, say, we want to take commodity risk off the table or we want to take interest rate risk off the table. But we can show how the portfolio performs, good or bad, in like a high inflation or a stagflation environment. Yeah, so that'll be part of the follow-up analysis.
I've always thought sometimes specifically deflation, which we haven't had here forever, but Japan, and just there's sometimes, I guess I've thought in my work, there were a couple of those, and that was one of them that you just always wanted to make sure you had some protection against. And I think it's built in here with the liabilities, the assets we have. I just wonder whether we want to state it in some fashion for, generations to come. You may or may not. I just wanted to throw that out.
And it's a fair point too, in terms of historically, we had an inflation sensitive asset class, right? Or really a risk group. And within that, one of the asset classes, we had a TIPS allocation, right? Which we never really liked TIPS that much. So what we did is we used TIPS substitutes, but it was for that very reason, because we felt we needed to hedge and provide some protection against inflation spikes, which I think worked reasonably well during that time period following COVID when inflation rose so sharply.
It's just a thought.
Of the policy for investment grade fixed income at 20.
Mhm.
I think in my mind at least takes the deflation scenario,
I agree 100%.
but it's the
I'm just
inflation
wondering
one.
whether or not, well, I'm just wondering whether we want to sort of have some just statement of this is a very old risk in the broader sense of an institutional portfolio. Term.
Right.
But of course, in the pension, you've got more defined time periods as opposed to institutional funds. So it may not be necessary for instance.
Also got the interaction with the liability side.
And the funding mechanism.
Right.
And therefore the state budget. So
Right.
it gets really complicated and out of our control really fast. So that's the other piece of it. Try not to open the aperture too wide.
Yeah.
I think what you'll see though, when we come back with sensitivity testing is the most problematic scenario is stagflation for a public pension fund. Corporate side is a completely different matter because the discount rate floats with the rate of interest, right? But for a growth-oriented portfolio, as Dan noted, we're 65 to 70%, depending on how you measure it, right? So in a stagflation environment, all the growth assets tend to do poorly. Yes, so we'll show the kind of the robustness and kind of vulnerabilities of these portfolios as well in that framework.
Kevin, I think you're doing this, but just want to make sure. So like with liquidity budgets or risk liquidity budgets, I hope that goes across asset classes. So in the guise of competing for capital, I'd rather spend my liquidity in certain spots rather than other spots.
Yeah, exactly.
It shouldn't be siloed. It should be across.
Okay, anything else on the LM? Thank you very much. We appreciate it. Okay, we will move on to the SRP support resolution. It was in your packet. You want to add anything to this one?
Yeah, I'll go through. I got a couple of slides. I'll go through a couple of them. Just should be quick.
Yep.
So joined up here by Reed Chisholm. He's the Assistant General Counsel for the supplemental retirement plans. So just as background, currently the Investment Management Division provides investment support and investment oversight for the supplemental retirement plans, which are the state's 401k, 457 plans. That oversight includes investment structure design, investment manager search, selection, and monitoring, oversight of the investment consultant, among other things. Full list of the responsibilities are in the supplemental retirement plan investment policy statement, which was included in your materials. The general statute 147-69.4A was passed as part of House Bill 506, which was the bill that created the NCIA. And it becomes effective January 1st of 2026. So this statute allows the Supplemental Retirement Board of Trustees to request the NCIA provide the similar or the same investment services that the Investment Management Division currently provides. It then requires the NCIA to consent to provide these services. And the statute also requires that any services provided by NCIA is done in a fiduciary capacity. Next slide. So the SRP investment policy statement. So the SRP board met on December 4th and officially requested the investment services from the NCIA and amended its investment policy statement as shown here to document the request and I guess presumed NCIA consent. And then a draft Go to the next slide. A draft resolution to codify the relationship has been provided in the materials. The resolution summarizes what I just went over, that the services being provided are the same as what IMD currently provides, that the NCIA will discharge its duties as a fiduciary, and that the resolution will become effective January 1st, 2026. And like I said, the full resolution is on the next page in the materials. Is there any question on any of that, or Reed, anything else to add on that?
Just to reiterate that the intent is to maintain the status quo.
Absolutely. So, yeah, happy to answer any questions on.
Pretty straightforward. Thank you.
Think so?
Thank you. Okay, we do need a motion to approve the resolution of the Board of Directors to provide investment services support to the supplemental retirement plans as requested by its Board of Trustees.
So moved.
Second.
All right.
So we're going,
Robert, Susie, Russell. Yeah, call the roll for the rest.
All right, Ms. Lynch,
Yes.
Mr. Ward?
Yep.
Treasurer Brennan?
Yes. Okay, we're approved. Thank you. Next, we'll go to board comments before we go to public comment. So for the board, any other topics you want to raise? We've been asked, obviously, to provide thoughts about scenarios that we want our tech and the team to model for the February meeting. So you can do that offline, you can do that now, whatever you'd like. But I'll open up the floor for any comments on any of the topics.
Look, I just reiterate, look, you guys have continue to do a great job. Thank you for all the effort you've put into this. It's very thoughtful and reflective of how the world is changing. The investment management industry is changing too, which is very important. So.
Okay, then we'll move on to public comment. We'll now provide time for public comments from anyone who has signed up. Do we have any public comments?
No.
Disappointing. So we will consider the public comment section closed, which means we need a motion to adjourn.
So moved.
Mr. Roberts, is there a second?
second.
Mr. Russell. We'll go ahead and call the roll. Why not?
Ms. Lynch,
Yes.
Mr. Ward?
Yes.
Treasurer Brennan?
Yes. Thank you, everybody. Happy holidays. Appreciate all the hard work and more to come in 2026. Take care.
Thank you.
Hi, everybody.